Welcome to the Renee Lobo Report, bringing you issues of topical interest. Hello everyone, I'm Renee Lobo and welcome to the Renee Lobo Report, bringing you issues of topical interest. Just a few weeks left for 2012 to end, and this is the time when we have to start thinking about tax filing, tips and advice. Especially this is a time in the holiday season when you like to share and give. It's a time for charities. So this is the time when you have to plan and actually give out so you know get the best bang for your buck when you file in April 15th next year. So telling us all about some great tips and advice for all of us. We have with us some great tax consultants, and they've been here before many times on our shows. It's Cecil Nazareth. He's a CPA as well as a chartered accountant, so he covers both India as well as United States. Thank you, Cecil, for coming back.
Thank you, Renee.
And joining Cecil Nazareth, I have Vinay Navani. He's a certified public accountant with the tax firm of Wilkin Guttenplan. And again, Vinay also has been coming here many, many times on our show, giving us some valuable tips and advice, how to do year-end planning, as well as so many FBAR advice, tax planning tips. So today is a day these gentlemen are going to guide us through a lot of, bureaucracy that happens, paperwork that gets tedious and cumbersome. What to do, how to file this, will that be deductible, deducted for my tax and so forth. So let's talk about tax filing of 2012. Year-end filing, very important for everybody, because this is the time when you want to give charities. At the same time, you want to know exactly it's a legitimate bona fide charity. So let's talk about, an overview picture, first of all. What advice would you give our viewers when they're filing for next year? This is year-end filing tips.
So, that's a good point, because everybody thinks about taxes in April,
right.
and in April it's too late. It's right now, before we hit the end of the year, is where it's really important.
Right.
And a good related point to that is with the hurricane that we've had in the Northeast recently. A lot of people have had significant losses, and there could be some tax benefit from those losses. So this is an important time to get your arms around those losses to help utilize that benefit for your tax return.
So casualty losses for individuals, for businesses,
Correct.
And even for corporations.
Correct.
Because I know that houses were washed away or burned down, or business was completely washed down by the angry waters.
Yes.
So how do they go about getting even grants, assistance, loans, and applying for deductions?
Right. So that's a whole separate show we can have about getting the grants and things like that. But let's just focus for a minute on the tax, the tax benefit. So if somebody had a house, for example, that was completely demolished, what happens is you look at your cost of that house.
Okay.
And the cost of that house is going to be allowed as what they call a casualty loss on your tax return.
Okay.
And the important thing is that to the extent that that loss exceeds 10% of your income, then that's allowed as a deduction on your tax return. Mm-hmm. Okay. Now, in previous hurricanes, the biggest one being Hurricane Katrina, the Congress actually passed a law to waive that 10% floor. Now, that hasn't happened yet. So right now, the amount of the loss has to exceed 10% of your income. Mm-hmm. So if your income is $100,000, for example, obviously 10% of that is $10,000. So losses over that $10,000 threshold are going to be allowed as a deduction, as a casualty loss.
Now, what would you need in terms of paperwork? You have somebody to evaluate
Yes,
this?
you're going to have proof. Usually what happens is, hopefully most people have not had a complete loss, so they've had some damage. And in that case, the best estimate of what's been the damage is the cost to repair the property to its pre-storm condition. So usually those estimates and those actual cost of restoration will be what the IRS looks to as the amount of the casualty loss. Now, a very important thing about casualty losses when they happen in a presidentially declared disaster area, like all of New Jersey, parts of New York and Connecticut were, is that you can actually have a choice. You can, because the storm happened in 2012, you can claim that casualty loss on your 2012 tax return that you file next year.
Okay.
Or you have the ability to amend your 2011 tax return today and get cash back today.
What's the deadline for, if it's for 2011 that you want to file?
Well, you actually have 3 years. So,
Okay.
so you can amend that return. So you really have two things to consider. If you need the cash right away,
Right.
then you're going to amend 2011, and you're not going to wait until
Right.
next year.
Right.
But it could also be that, because of that 10% of income floor that you have to exceed, if income in 1 year is significantly lower than the other, you might be better off, claiming the casualty loss in that year that the income is significantly lower, because more of it will be a deduction.
Right. Now, if you're talking of casualty loss with houses, could be even apartments.
Could be apartments, personal
Okay.
property, or a
What
car.
about content?
Content qualifies for this, but again, it's got to
Okay.
exceed the 10% floor. You need to have, some itemization, the more documentation you have, the better. Of course, by nature of a casualty, you're not going to have much documentation because most of your documentation got washed away, but
Right.
the more documentation you have, the better.
I see. And this applies for casualties and business as well?
Businesses, the rules are slightly different. That 10% floor doesn't exist for a business loss
I
as
see.
it does for an individual, but otherwise the concepts are the same.
So is it less or more for businesses?
Well,
Casualties?
ultimately, it's going to be, you're going to get more of a benefit because if a business and an individual have the same loss, the business doesn't have to exceed that 10% threshold.
I see.
So-
I see.
Just one comment on that, Renee. We want to make sure that you have to deduct reimbursements. A lot of people just claim that.
Excellent
You
point.
got to be careful that if the insurance company reimburses you, your loss is reduced.
Right.
Okay, and let's not, or on the business side, there's also loss of business insurance because they are totally devastated, so they cannot conduct business for the next 6 months.
Right.
Then they have insurance for that. That is
I see.
totally
So if they're being
independent.
reimbursed
That is correct.
by the insurance companies.
Or by FEMA,
Or
Or
by
any
FEMA,
other
yes,
association or
exactly.
agency, you have to deduct the loss accordingly.
Then
So-
you can obviously say, well,
That's double
I
dipping,
think
right?
Yes.
the gap between what they got and what
exactly.
Absolutely.
that's where they
It's
come
your-
in
what's your
with that.
true economic loss?
Exactly.
yeah.
So we have to be very careful when you're itemizing deductions.
Absolutely.
But I think those who did not have flood insurance,
That is correct.
they probably qualify for this
Absolutely right.
tax deductions.
Absolutely right.
Now let's talk about those 3 golden rules of
Three golden rules.
tax.
Okay.
Yes. We always consider, tax planning when you're planning for the year end, and I'll repeat what Vinay said, is April is too late. We want to focus in December, any adjustments that we have that we can take advantage of. For example, we want to make sure that all our deductions, we maximize our 401k plans. We want to make sure we get state tax deductions. So the golden rule, we want to pay tax as late as possible, the taxes itself. We want to pay as little as possible, right? And the third is you want to make sure you don't go to jail, right? Because a lot of people, they think it's deductible or not deductible. Like in FBAR cases, we have discussed on our show, Renee, that we want to make sure we are on the right side of the law. And the golden rule is it's never too late to file and comply.
Right, right. We always talked about FBAR many
Absolutely,
times. That's
absolutely.
very important.
So-
I mean, it was always there. Now it's been strictly enforced.
That is
so
correct.
people
That
should
is correct.
be, cautious about that.
That is correct.
Let's talk about traditional tax planning. We're talking of long term as well. We talked about 3 golden rules.
Right.
Yes.
Pay your taxes.
Right.
But as much as you can delay it and pay whatever little
Yes.
Correct.
it's supposed to be
Correct.
legitimately.
Correct.
Yeah.
And I'd add one more point to that, Renee. This is a famous joke that tax avoidance, people are living in Florida, tax evasion, you go to jail.
Exactly.
Right? So there's a big difference between avoidance is called tax planning. We plan to optimize our tax position.
Yeah.
And an add to that is a global tax position.
Yeah,
Don't just
exactly.
forget the U.S.
Yes.
and you forget your assets in India and all over the world, and then you'll get into another situation.
You have
So
to be a smart and savvy
Smart.
taxpayer.
That's
and
called
we're not
tax
talking
avoidance.
About evasion.
That's planning. All tax planning and tax avoidance legitimate as long as you're abiding by the tax code in all the countries.
Right.
Really legitimate tax planning can save you millions of dollars.
Right.
So
So let's talk about deferred income and and
Yes.
accelerated deductions that we're
Yes.
talking about.
yeah, so traditionally we always accelerated expenses, deductions,
Of course.
and we deferred income. But since the rates, that is a great strategy when rates are going down or constant. But when rates are going up, you want to do the exact opposite.
I see.
You want to accelerate income because this year the rates will be lower, next year the rates are going to be higher.
Right.
So you accelerate income more, like a lot of companies are paying dividends this year, and you see that all over the news. The reason being the rates are at 15%. There's a strong possibility it might go to 20 or higher next year. So great reason to take dividends this year. So that's an important point. Now you want to defer
When we
deductions.
talk of this year, we're talking of end of
2012.
So December 31st is the
Absolutely.
cutoff date.
Absolutely. Now, even in traditional and previous years, we used to take state taxes, and prepay our state taxes, because even though they're due Jan 15th, we would want, or Jan 1st in real estate taxes, whatever, we'd pay them up front, like on December 15th or 20th,
Yes.
so that we get the benefit this year, because we are cash basis taxpayers. But this year it makes sense to put it back, push it back to 2013, because your more income will be taxed at a lower rate, and you'll get a better deduction next year, which will be a higher rate. That's our point. And then Vinay, if you want to
Vinay,
add
wanna-
anything to that.
Yeah, I mean, I agree with all that, but you also have to look at where you are on the income brackets, right?
bracket.
Yes.
Because people who are, I know we don't want to get too much into the 2013 taxes,
Right.
but if you're on the, I'm going to call it just arbitrarily 100,000 or less, if your taxes go up, they're probably not going up a lot.
Right.
So you may still want to do some of the traditional tax planning that is,
Good point.
taking advantage of your deductions now and reducing the check you have to write next April. So everybody's situation is going to be different based on their circumstances and their belief as to what's happening next year. So it's hard to give rules as to, one size fits all.
Absolutely
Is the
agree.
challenge of this time of year.
That's why I think where CPAs and chartered accountants come in the picture. And when we talk about itemized deductions, one, of course, there's standard deductions that you
Yes.
get. Now, when
Yes.
you're itemizing, then you got to be very careful what you're taking out.
Correct. You have to look at all your itemized deductions, add them up, and see, okay, if I add all these deductions together, do they add up to more than the standard deduction?
Ones, exactly.
And whichever one gives you the better answer, obviously, you do.
Right.
So the biggest, itemized deduction that many people have is what you open the program with, is charitable
Yeah,
contributions,
charities,
which is,
yeah.
an important consideration at this time of year,
Right.
because many people are giving because they want to, as well as for the tax benefits. So, a dollar given today is going to save you whatever your tax bracket is.
Now, in a standard
that.
deduction, if you're talking about charities and itemized deduction, which one comes out better in terms of, like, in a standard deduction, there has to be a fixed kind of an amount, or there's a,
Correct. There's a fixed
cutoff.
amount based on your filing status,
Okay.
and then you're going to compare that to all your itemized deductions. And the main categories of itemized deductions are the taxes that you pay,
Right.
the interest expense that you pay, the charity that you pay, and then a few other miscellaneous categories. So charities are one component of that. So you have to
so
consider
what
that.
percentage of their income will come out to be itemized and not standard, or vice versa?
You can't look at it that way, because the standard deduction is a fixed amount based on your filing status, right? So it could be anywhere from $5,000 to $10,000.
Okay.
Right, so if somebody is going to look at giving a charitable contribution of, let's say, $15,000
Correct. That's what I meant.
by itself,
Right.
then you know that the itemized deduction is going to be greater than the standard
Right.
deduction, because even once you add the other things,
Exactly.
you're clearly going to be more than your standard deduction.
So I would say in standard, you would have like probably $4,000 to about $6,000-7,000.
Approximately,
for charities.
approximately.
Okay, all right.
So-
And most people also in the tri-state area, their taxes are very high on the state levels. So that becomes a deduction too. So you also want to
Yes.
evaluate or look at both the charitable contribution and the state taxes that you're going to pay, add them all up. And most people in the tri-state, they exceed that threshold way above.
Right, like a lot of people, right now, who are victims of Hurricane Sandy are living in shelters, and people would like to donate, so they may give more donations than they gave last time.
Right.
So it could become itemized deduction in charities rather than standard deduction.
Wonderful point. They may have had the standard deduction
Yes.
last year, but if they
Right.
increase their charitable contributions, they may itemize this year for 2012.
So that itemized deductions, is it very tedious to go through? I mean,